Hello everyone, this is Kevin Zhao. In this chapter, you will learn why investors buy bonds, passive versus active bond management, and the concept of duration, the measurement of bond interest rate risk. Bond investment is attractive both in long-term and for both long-term and short-term investors due to its stable coupon income and the potential capital gains. Bond investors get a sense of return certainty of yield to maturity at the very beginning. Foreign bonds are also attractive to investors due to its higher risk and higher returns. Another unique aspect of foreign bond investment is the currency risk. However, currency risk can be hedged away by using certain financial derivatives. The surprising fact is that weak economy benefits bond investors. Why? In weak economy, the Federal Reserve often cut interest rates to help the economy. There is an inverse relation between the interest rate and the bond price. Low interest rates will boost the bond prices. There are two basic bond management strategies, passive one versus active one. The passive strategy assumes bond market are efficient and the bonds are fairly priced. The passive bond investment strategy involves buy and hold as well as indexing. Investors try their best to mimic a certain market index so that the investment return can be matched with the index. The active strategy takes a very different stand. It assumes that the bond market is not efficient and the bonds are often misvalued. Investors differentiate their portfolio from the bond market index, try to beat the performance of the index. It involves forecasting of interest rate change, identifying abnormal yield spread, and identifying mispricing in certain bonds. However, forecasting interest rate change is very challenging. Horizontal analysis is a great tool for active bond manager to forecast the bond price based on certain interest rate expectations. This slide is about yield spread and potential mispricing that investors can discover when they do active portfolio management. Duration is a measure of bond's lifetime. It equals weighted average lifetime of coupons and principal payments. Specifically, duration can be calculated based on this equation. As you see, duration is determined by first, the maturity, and the second, coupon payments, and the third, yield to maturity. Duration is higher when maturity is longer, coupon payment is lower, and the yield to maturity is lower. Why duration? It seems that duration is a measure of bond's lifetime, but the secret is that duration is the best measure for bond interest rate risk. It measures the bond price sensitivity to the changes in the interest rate. This equation shows another way of calculating duration, which is based on price sensitivity to changes in interest rate. Duration has a powerful interpretation on interest rate risk. For example, if a bond has duration of 20, then it indicates that when interest rate change by 1 percentage point, the bond price will change by about 20%. Specifically, if the Federal Reserve decides to raise the interest rate by 0.5%, then the bond price will decline by about 0.5% times 20 equals 10%. Convexity is a refined measure for bond price volatility in addition to duration. Managing bond investment risk is often equivalent to managing bond duration. To maximize gains in the environment of declining interest rates, investors should choose bonds with higher duration. To minimize losses when interest rates are increasing, investors should move to bonds with a low duration. Immunization strategy is a strategy often used by insurance companies and pension plans to immunize their business from any negative impact of interest rate changes. To implement the immunization strategy, the investor needs to match the duration of their bond assets and the bond liabilities so that the impact of changing interest rates on both assets and the liabilities cancel off completely, leaving their business immunized to any interest rate changes. I hope you enjoyed today's video. This is Kevin Zhao. I'll see you in next class.